On September 14, 2008, New York City didn't feel like it was standing on the edge of history. The streets around Wall Street were calm. Yellow taxis moved through intersections, street vendors were closing their stands, office lights flickered behind glass towers. It was a Sunday evening. Traders were preparing for Monday, checking emails, reviewing market reports, finishing coffee before heading home. Nothing looked unusual. Nothing felt urgent. If you stood outside Lehman Brothers headquarters that night, you wouldn't have seen panic. You wouldn't have seen fear. You would have seen a building that had stood proudly for over 150 years, quiet, confident, unshaken. But inside that building, behind secure doors and guarded elevators, something was breaking. Phones were ringing constantly. Conference rooms were filled with senior executives. Lawyers were reviewing emergency documents. The conversations were no longer about profit. They were about survival. Because within hours, one of the most powerful financial institutions in the world would admit something unthinkable. It was out of time. And when markets opened the next morning, the shock wouldn't stay on Wall Street. It would travel across continents, across banks, across families. And the word safe would never feel the same again.
Lehman Brothers wasn't just another bank. It wasn't a startup chasing fast profits. It wasn't a risky experiment. It was history. Founded in 1850 by three immigrant brothers, Lehman began as a small cotton trading business in Alabama. It survived the Civil War. It survived the Panic of 1907. It survived the Great Depression. It survived 2 world wars. For more than 150 years, it adapted to every crisis. It expanded into investment banking, into trading, into global finance. By the early 2000s, Lehman was a titan of Wall Street, managing over $600 billion in assets. Its headquarters stood as a symbol of American financial power. Investors trusted it blindly. Governments consulted it. Corporations depended on it. Its executives appeared on television with confidence. Its reports projected strength. Its balance sheets looked solid. To the outside world, Lehman Brothers was untouchable, too big to fail. But sometimes, what looks solid from the outside is quietly cracking within. Cracking within.
But the real story of the crisis didn't begin inside banks. It began in neighborhoods. Across the United States, home prices kept rising year after year. Owning a house started to feel like the safest investment anyone could make. Families believed prices would never fall. Banks believed the same thing. And when everyone believes something will rise forever, risk begins to disappear. Banks started approving mortgages faster than ever before. Income verification became flexible. Credit requirements became weaker. If you wanted a loan, you could get one. Millions of Americans suddenly had access to mortgages they could never have qualified for in the past. At first, the system looked like it was working. More homes were being sold, more neighborhoods were growing, and more money was flowing into the financial system. But beneath the surface, a dangerous bubble was growing. And like every bubble in history, it was only a matter of time before it burst.
But the housing boom alone wasn't enough to crash the global economy. What made the crisis truly dangerous was what banks did with those mortgages. Instead of keeping the loans, banks began packaging them together. Thousands of mortgages were bundled into complex financial products. These products were then sold to investors around the world: pension funds, insurance companies, investment firms, even foreign governments. They were told these investments were safe. They were told the risk was low. After all, how could millions of homeowners fail to pay their mortgages at the same time? Rating agencies gave these products high safety ratings, AAA, the highest rating possible. But the truth was very different. Many of the loans inside those bundles were extremely risky. Some borrowers had no stable income. Some had poor credit histories. Some could barely afford their first payment. But on paper, everything looked safe. And as long as housing prices kept rising, no one asked questions. For years, the stock market had only moved in one direction: up. Every week, new records were being set, new millionaires were being created, and newspapers kept repeating the same message: America was entering a new era of endless prosperity. People believed the market could never fall because it never had. But behind the celebration, something dangerous was growing. Prices were rising much faster than the real economy. Companies were being valued far beyond their true worth. And many investors weren't using their own money, they were borrowing it, buying stocks with loans, betting everything on a future that seemed guaranteed. But when a system depends on endless optimism, all it takes is a single moment of doubt to begin the collapse. By October 1929, the first cracks began to appear. Some investors started selling their stocks, not because they knew something terrible was coming, but because they felt something wasn't right. At first, the market only dipped slightly. Nothing unusual, nothing alarming. But in markets driven by emotion, small drops can turn into massive fear. As prices began to fall, more investors rushed to sell, and the more they sold, the faster the market collapsed. The panic had begun. October 24, 1929, later known as Black Thursday. That morning, millions of shares were suddenly put up for sale. Investors were desperate to escape the falling market, but there weren't enough buyers. Prices collapsed within hours. Panic spread across Wall Street. Crowds gathered outside the New York Stock Exchange. Rumors spread through the city. Some said fortunes had vanished overnight. Others feared the entire financial system might collapse. But the worst was still coming. Over the next few days, the situation became even worse. Investors who had borrowed money to buy stocks were now drowning in debt. Banks began demanding repayment, but investors had no cash left. Their wealth had existed only on paper, and now that paper was worthless. On October 29th, the market collapsed again, a day that would later be known as Black Tuesday, the true beginning of the Great Depression. After the market collapsed, the damage didn't stay on Wall Street. It spread quickly to the banks. Many banks had invested heavily in the stock market. Others had loaned money to investors. When those investors lost everything, they couldn't repay their loans, and suddenly, banks began to collapse. People rushed to withdraw their savings. Lines formed outside banks across the country. Families stood for hours, hoping their money was still inside. But for many of them, it was already gone. As banks failed, businesses began collapsing too. Factories shut down, stores closed, companies fired workers by the thousands. Soon, millions of Americans were unemployed. Entire families lost their income overnight. Homes were abandoned, savings disappeared, and for many people, the American dream suddenly felt impossible. The Great Depression had begun. Across the country, the effects of the crisis became impossible to ignore. Long lines formed outside soup kitchens. Men waited quietly, sometimes for hours, just to receive a small piece of bread. Families who once lived comfortably now struggled to survive. Pride was